Welcome to Market Call. Thanks for joining us today. I'm Marilla Fernandez. Andrey Omelchak is on the show, CEO and CIO at LionGuard Capital Management. He'll take your questions on North American equities. Here's how to reach us. 1-855-326-6266 if you want to call in. You can reach us by email as well, marketcall@bnnbloomberg.ca. Andrey, good to see you. Thanks for coming in.
Great to be here. Thank you.
Let's talk about tech stocks, which have very high valuations. We've all kind of accepted that at this point. But you are saying some of the other companies are also testing valuation levels. What kind of companies? Are there certain sectors where you're seeing that?
Well, overall multiples, if you look at S&P 500, are starting to test all-time highs. Usually there's a pullback after those levels, but for market to continue to work, we really need to see either multiple expansion or continued earnings growth rate. So tech, of course, if you look at the Magnificent Seven, the valuation multiples are more than 30 times earnings now. So you really have to trust that they're going to continue to grow their earnings. And I'm not saying they won't, but you have to make that call if you want to participate in those companies. And overall broad market, we're also seeing expansion of multiples in the US.
Do you feel like there's a correction coming then?
I think 95% of the time it's impossible to make a market prediction where it's going. There are some reasons to be positive, of course. If you believe that AI innovation cycle will kick in and there'll be efficiency gains coming as a result of that, we can see a quite significant earnings growth rate on the back of those. So
it feels like Canadians are still optimistic. And I'm wondering if you think it's because they think the trade war has wound down. And even though it's not over, they feel like it's settled. Do you feel that is one of the reasons they could be optimistic here?
Yes, absolutely. I think Canadian investors have put behind them the trade war, it feels like, based on where the overall market is trading and how stocks are behaving. Renegotiations on CUSMA haven't really started yet in a big way. Of course, we're getting all types of signals from the Washington and from Ottawa as to what could be, but we don't know yet for sure. So I think maybe we're a little bit ahead of ourselves. That's my sense.
Okay, what are the sectors you like right now that you find are more reasonably valued?
So I purposely stay out of the resources sector as part of my investment process.
Why is that?
Throughout an investment cycle, they don't create that much value. Of course, when you're in a bull market for resources space, you can make a lot of money. And right now, we're in one of those bull cycles. How long it lasts, we don't know. How it ends, we always know. So you have to be out of the party at the right time. I see a lot of values in number of companies on the industrial side, some specialty financial services. You have to pick your spots, but I think there are a lot of opportunities there. Especially in Canada, the fund flow dynamics leads often outside of some of those sectors when everybody's trying to chase the commodity cycle.
Got it. Okay, we'll talk about some of those in the next hour. Andrey Omelchak of LionGuard Capital Management today, taking your questions on North American equities. Here's how to reach us, both phone number and email address. We're back in a moment. Stay tuned. Welcome back to Market Call. We're going to start with an email from Jen today. She says, what's happening with MDA Space? Should I buy, sell, should I hold? Andrey, of course, MDA Space, Canadian company. They do low orbit satellites, but they lost a big contract, I think it was last week. And so investors have been sort of selling off that stock, and it is down quite a bit, hasn't really recovered. We'll pull up the chart in a moment. But is this a company you think has enough growth moving forward? It could recover? Should the investor hold?
So we really have to understand why they lost a big contract. It's more than $1 billion, and they have a high client concentration. So initial reaction should be, to be cautious before you try to figure it out. Our channel checks lead us to believe it's an isolated incident, although we don't have 100% confirmation that this is the case. The company to which they lost the contract had to sell their spectrum to SpaceX. For various regulatory reasons. That's what we believe. As a result of that, we think the rest of the business should be intact and they should not be negatively impacted. And based on the backlog they have from the other clients, we think they can fill up those spare capacity and they should do fine going forward.
And they do have an expansion coming in Quebec to tell you how much of a backlog they have. They're actually building out to accommodate. So there's definitely enough interest in their product.
Oh, the backlog is huge. It's in tens of billions of dollars. if you believe the management team and all the industry experts, that's what they're saying. And now, are they competitive enough to really capitalize on that backlog? Can it go to somebody else? So the question here is, the clients that, of course, in Canada will have to choose MDA for various reasons. A number of European clients, I think, also going to choose MDA. But if you're in the United States, do you have to prioritize US domiciled supplier? And that's where the big question comes in. So I think some prudence is warranted, but overall, I think they're going to be able to backfill their backlog and to make sure that they have enough business to make up for more than $1 billion of lost client orders.
Okay, let's go to the phone lines, and we have Costa on the line in Montreal. Hi, Costa.
Hi, Mirella. Hi, Andrey. Thank you for taking my call. Andrey, we both love Constellation Software. I have all my money in this beautiful company. Do I have your blessing for the next 20, 30 years to leave a whole bunch of money in this company? And would you know why the stock has been falling lately? Thank you so much. Have a great day.
That is a big promise he wants you to make about the next 20 years for Constellation Software. It has dropped down $49 just today, but it's at $4,057, excuse me, down to $4,241, but up 125% over the last 3 years. Is this a company you think will recover?
So, Costa, great question. I'm a huge fan of Constellation Software, as you rightly pointed out. I think this is a blip and a major buying opportunity for that company. And the reason why it has corrected is because there is a big misconception in the industry that vertical market software companies, the likes of Constellation Software, Lumen Group, and Topicus, for example, which are spin-offs from Constellation, will be negatively impacted by some of the AI developments. In fact, it's completely the opposite, in my opinion. They're going to benefit quite a lot because these are integrated companies, integrated businesses. You cannot displace them easily. What will happen, in my opinion, is that we will see significant margin expansion that nobody's talking about yet. And also, we're going to see the resurgence in innovation cycle when you can invest into some of the growth CapEx initiatives and get much faster payback as a result of that. So I expect actually acceleration of organic growth rate. I expect very significant margin expansion and everybody jumping back into those businesses once those concerns alleviate. So you do have my blessing. I don't know if it's a 30-year blessing or not. It depends on valuation. I think every company has a certain level when it becomes overly expensive. But there is a multi-year horizon for Constellation Software and for both spin-offs, Lumen and Topicus, to continue to grow and to deploy the capital at very high rates of return for an extended period of time. So you do have my blessing for at least the next 10 years.
Okay, and we just got a note here that was for Constellation Software conference call to discuss AI's impact on software business, which is the overarching question a lot of investors have that you were touching on just now. We'll talk about more of that later in the show. Let's go to Faisal in Toronto. He has a question. Hi, Faisal.
Hi, Mirella. Hi, Andrey. I hope you both are well. Thank you for taking my call. Andrey, my question is on Vital Hub. They had a bought deal a few months back at $12.70, which was oversubscribed for. Since then, the stock has sold off, and it's sort of around $11.15. Can I get your thoughts on it and its future growth prospects, please? I'll hang up and listen. Thank you.
Okay, thank you for the question.
Yeah, sure. Great question. Vital Hub is one of the small cap Canadian compounders. What happened is they raised, I believe it's more than $70 million. They have a very big M&A pipeline. They can continue to deploy the capital. The reason why it sold off is because they made 2 large acquisitions, actually the largest they did throughout their history. And it takes a while to integrate some of those acquisitions. I believe initially it will be margin dilutive before they get to capitalize on some of the benefits of the integration. This will happen. It takes a number of quarters for this process to be digested. But management is laser focused on making sure they improve the margins. And I believe that once this is done, investor concerns will alleviate. And in the meantime, they're also busy in looking for more acquisitions.
Okay, let's hope that gives Faisal what he was looking for as we move on to Tom, who's in Barrie, Ontario. Hi, Tom.
Hello, good afternoon. I just want to ask your guest about Shopify. I have it. I did very well with it. I just want to know, because of the earning ratio is very high, if it's to buy more or to sell it, and if he has some of it too. Thank you.
Okay, thank you for the question. Shopify up 439% over 3 years. It is pretty volatile stock. Is this a stock that you like?
I think it's a solid hold for the investors. I would not buy it aggressively. As the caller said, valuation multiples are pretty elevated. At the same time, the execution has been phenomenal, and I think it can continue being phenomenal for a number of years to come. I see further margin expansion opportunity. What they're doing is strategically important for small businesses for whom they're working. Also, they're innovating, so I think there's going to be acceleration of some of the organic growth rate for Shopify. So I can't say it's a screaming buy, but I think it's a solid hold for the investors, especially the management team that's at the helm of this company.
Why is it such a volatile stock? All things considered, the business has been growing. They're taking on larger businesses now to provide a platform for them as well. Why does that stock move so much?
It's a question of whether or not they can be disrupted by somebody else. Can somebody come up with a product and satisfy the demands of small and medium-sized businesses in a similar way? And I think those concerns, they come in and out, and then Shopify comes back and shines through. So they have shown that resilience and that stickiness to their client base. And also the higher multiple doesn't help. Higher multiple leads to high volatility, as it should.
Okay, let's take a quick break. We'll line up some more phone calls for Andrey Omelchak of LionGuard Capital Management. He's taking your questions on North American equities. Here's how to reach us. Back in a moment. Welcome back to Market Call. Let's go to the phones. Anita's on the line. She's calling from Markham, Ontario. Hi, Anita.
Hi. Good afternoon. Thank you for taking my call. My question is, between Aecon and Atkins Realis, which one would you prefer? Is there still growth in both the companies? And is this a good entry point? I own WSP Global and Brookfield Infrastructure. I'll hang up and listen to you. Thank you.
Okay, thank you for the question. We will pull up Aecon versus Atkins Realis as to where the growth is. Do you have a preference between the two?
Well, it depends on your time frame. If you think in next 12 months, I think potentially Aecon can do better. It's more Turkey as an investment. It's very much exposed to the Build Canada. Much bigger portion of their revenue comes from Canada than Atkins Realis.
Which is global.
Which is global, but they do have the biggest portion of revenue as compared to WSP and Stantec coming from Canada. So if I was to choose, for example, between WSP, Stantec, and Atkins Realis, I would choose Atkins Realis right now because about 20% of their revenue comes from nuclear, which is absolutely booming. So between those three, the choice is obvious. Atkins still trades at a valuation discount relative to the other two. Now, when it comes to the Aecon and Atkins Realis, these are very different businesses. They're exposed to some of the same dynamics right now because of the Build Canada. And I think investors will make quite a bit of money if they're exposed to those Build Canada dynamics. And once again, it depends on the time frame. So over the next 12, potentially 18 months, Aecon should do better, in my opinion, because their backlog will expand significantly. And this is a good business for them. It's very, very talky, once again, to the project announcements once they start coming through. So we'll look forward to that. And Atkins Realis also is exposed to that. But mostly what I'm excited about is the nuclear business.
Which is a longer-term investment there.
Which is a longer-term investment, but it has been absolutely booming.
Yeah.
Because small modular reactors are coming in Canada. And because I think the nuclear side is still understated by investment analysts.
The one that is being built in Darlington, Ontario, this first small modular there, is Atkins Realis involved in that one, do you know?
Yes, absolutely, yes. Okay. They will participate on that. It will be a good margin business for them.
And the starting place for that to take off?
It is starting to take off. As you know, there is a massive shortage of power that we are experiencing on the back of the AI boom and data center build-outs. And the power infrastructure we have in place right now is simply insufficient. So nuclear has to be part of the solution. Okay. And I think we have also received the social acceptance of that, I find. If you go back 10 years ago, nobody wanted to talk about nuclear.
Minds have changed about a lot of different things over the last couple of years. That is for sure. Okay, let's go to an email from Colby. He says, any thoughts on Aritzia for the long-term hold? Aritzia has been doing well. It feels like they haven't been hit by tariffs like some of the other clothing retailers. It is up to sort of 86.50, up 82% over the last year, and they're expanding. Given the climate, is this a stock you would invest in at this point?
Aritzia has been a great company over the longer term. They have something unique. There has been hiccups on the way to get there, especially in a post-COVID world. I know we don't talk about COVID much anymore, but they missed the newness factor. They didn't have as much innovation of the new clothing. Now they fixed all of that, and that's why the stock has come back. What I like is that the payback on new store openings is very, very high. They don't open that many stores, not as much as Group Dynamite, for example, but the still square footage growth rate of new stores is significant, and the payback on that is very good. Of course, it's a retailer, so you have to keep that in mind. So when you speak about the longer term, you have to appreciate that things can change, and you cannot own a retailer for next 10 or 20 years and think you know how this will unfold. It simply is not the type of investment.
How long, I mean, it's kind of a question that puts it up in the air. How long would you hold onto a retailer? Is it one of those things that as soon as the economy begins to turn, you look to get out? Because discretionary spending is the first to go, right?
There's discretionary spending component for the sector as a whole, but something that's even more important and exciting is this something cool? The coolness factor for the retailer is extremely important.
And for that, we have to check the children.
And for that, we have to see the statistics. You have to see same-store sales growth rate. We have to see how they're benefiting from their marketing strategy. So Aritzia is doing a lot of things right. They opened a distribution center in Ontario. That's doing great. They're opening new stores. Their online strategy is working well. So everything's working well for them for the time being. I think it's a solid hold for now. I don't know where it's going to be 10 years from now, though.
Okay. Let's go back to the phones. John is on the line in London, Ontario. Hi, John.
Thank you, Marilla. Dzień dobry, Andrey. Elon Musk is buying Tesla again, which is rare, and the stock likes that. The market likes that. I wish to get your opinion on whether my wife should add to Tesla on the occasion of our silver wedding anniversary. Thank you very much.
That's what she wants to do for her wedding anniversary. Very interesting way of celebrating. Okay, so Tesla, we pulled up here, 418. It's up 2% on the day, 81% on the year. Elon Musk this week buying some of the stock. What are your thoughts on Tesla?
Well, first, congratulations on your forthcoming anniversary. Now, as it relates to Tesla, I wish I had a crystal ball. I don't think anybody has a crystal ball when it comes to Tesla. One thing I can tell you is that it does not pay off to underestimate Elon Musk historically. They're talking about $10 trillion opportunity potentially for the robots they're working on. It remains to be seen, how this translates into the actual market demand. Also, energy storage, part of the business. A lot of questions there. How big can this get? So I wish I could answer more conclusively. I like to buy businesses that are not trading at very expensive multiples. Of course, Tesla does trade at very expensive multiples. The last time I checked, it touched 200 times earnings. So there's a lot baked in a Tesla magic and in Elon Musk's ability to continue to reinvent the business and to take it forward. I cannot recommend you one way or another, especially given it's an important anniversary and you want to put more capital to work. But I could go back to another caller question and tell you Constellation Software. If you were to buy that business or any of its spinouts, Lumen and Topicus, I think your wife will be happy on your next anniversary.
Yeah, but that means he has to spend more money for that one. That's the gift he's got to put a ribbon on. We'll see if he does that. All right, we're going to take a quick break. Andrey's past picks are coming up next. Stay tuned. Welcome back. Time now to have a look at Andrey's past picks from September of last year, September 10th. At the time, he chose Lumen, which we will take a look at here, was recommended at 36.21, and now up to 46.37. And the return is 28%. The total return is the same at 28%. They're a software company for media. And we were touching on the fact that people are concerned that software doesn't have a future because AI will sort of wipe everything out, and the need for software, everything will be built in. Is this a company that you're still invested in, that you still like?
Yes, absolutely. We like Lumen a lot. They think it's massively mispriced, despite the 28% return over the last year. There's a massive misconception around AI, as I was commenting earlier. It will benefit vertical market software companies that are integrated into the business operations. It will only hurt companies that are doing something very simple on the surface. Other companies like Lumen will be able to expand their margins and will be able to accelerate their top line organic growth rate. In addition to that, Lumen has a huge opportunity to continue making acquisitions at very high rates of return, 25% plus after-tax rate of return. That's what they've been able to accomplish. What they did over the last 12 months is nothing short of extraordinary. They made a big acquisition, and they increased its margins in a record period of time, really highlighting that the business model works extremely well.
Okay, so it's something you would definitely hold on to moving forward. Let's go to your next past pick, Trisura Group on the TSX. Recommended at 39.27, now at 39.78, so a 1% return in total return. They're an insurance company. Why did you pick Trisura?
It's a specialty insurance company. It is very cheap given the quality of the business. They're delivering clean quarters, and they have a lot of growth opportunities, mostly in the United States on the US surety side of things. Trisura can continue to compound its book value per share at 15 to 17% annualized, in my opinion, for years to come. So given where it's trading, given the quality of the management team, the combined ratios, which are industry leading, I think it's massively mispriced. And it's a prime takeout candidate, frankly, at those levels.
Let me ask you about whether or not you see limited opportunity for them in the U.S., considering it's a Canadian company, and we know how much Donald Trump likes to protect American companies.
They have a lot of room and a lot of opportunities to continue to expand the United States. Donald Trump, of course, is focused on various industries. There has been zero impact for Trisura or some of the other companies which I'm following. So I see it as a non-issue at all. They're expanding very fast. They have presence across most states, and soon they're going to be all the 50 states. And the growth is tremendous for them.
Okay, let's go to your next past pick from September last year. Knight Therapeutics, which at the time was $6.04, now it's $6.34. So 5% return, 5% total return as well. This is a pharmaceutical company. Do they do licensing? Is that what they do, or royalties?
Yeah, so they do licensing of the products which they own, that's right. So they have operations in Canada and Latin America as well. It's amazing that the company has done such a great job over the last 12 months. It's practically flat. So it did fall, and now it's come back, and it's flat over the last 12 months. The top line is doing well. Their Brazil operations are doing really well as well, despite some of the hyperinflation issues they experienced in Argentina and elsewhere. The margins are expanding, and they're really moving in the right direction. So some patience is warranted. They're making some investments to accelerate the growth rate. But I think patient investors will be rewarded to keep holding Knight Therapeutics.
Okay, let's take a quick break. We're going to come back, take more of your phone calls and your emails. Andrey Omelchak of LionGuard Capital Management. We're back in just a moment. Stay tuned. Welcome back. Let's go straight to the phone lines. Amin's on the line in Ottawa with her question. Hi, Amin.
Hi, good afternoon. My question for the guest is on NVIDIA. Is it a buy at this price? Thank you, and have a nice day.
Thanks for the question. It's down to 175. It had hit a high of, I guess, 182. Yeah, that was sort of back in, I guess, in August, so not that long ago. Would you step in at this point for NVIDIA?
I think it's a solid hold. Clearly, they're doing something mission critical. The demand for the chips is not going anywhere. Others are not able to catch up. Their technology is so advanced. And we are really seeing an AI revolution. So I think the demand is there. it's nothing compared to the past dot-com bubbles when the earnings are not following the results of the company. In this case, the results are really following the stock price performance. So I think you should accumulate NVIDIA carefully on the pullbacks, and this is one of them.
So maybe step in sort of half a position if that's what you're looking at, or a little bit less, and then follow along?
That's how I would do it, yes. So that's a good suggestion, but probably not full weight. Still, things can be wobbly, and the multiple is still not that low.
Okay. Let's go to JC in North Bay, Ontario, with a question. Hi, JC.
Hi, can I ask about Badger daylighting? Do you think it still has upside with the Build Canada initiative, or do you think there's maybe something else under the radar that hasn't moved up as much other than like the Acons and the WSPs and the Stantec?
Okay, thank you for the question. Can you tell me a bit more about Badger and how it's different from Acon, for example?
Yes, it's a hydraulic excavation company. So they have those trucks, you can see them sometimes on the streets. They open up the underground infrastructure using the high-pressured water, and they suck the water out without damaging the underlying infrastructure. So they do something very unique. They're the biggest in North America. They have top management team right now, and the business is doing really well. So I see further margin expansion opportunity for Badger because management team is so running the business using a lot of data. They're very much data dependent. So as a result of that, I think utilization of trucks will continue to increase. The build rate is very prudent. They're not overbuilding trucks at all. And I'm pretty excited about what's happening. About 8% of their business now comes from data centers and data center adjacent businesses. So from utilities, for example, that service that. If you can imagine, you're investing billions and billions of dollars to build data centers. The last thing you want is to damage the infrastructure around that. That's really mission critical. So the Badger and the hydraulic excavation is perfectly suited for data center related work activities. Now, the question asked about Canada, about 10% of their business comes from Canada, so it's not that much. But if the Build Canada comes through, when the Build Canada comes through, the business in Canada will accelerate for sure. So it's not as turkey as Aegon, Bird Construction, for example, which I'm very bullish on, very much exposed to Build Canada dynamics. But it will certainly benefit as a result of that. So I think the run-up in the stock price, it's up quite a bit this year, is fully warranted, but it still trades at very attractive multiple looking forward. And given the visibility on top line and margin expansion, I think you can continue to buy it, actually.
Okay, good to hear for him. Let's go to Callie, who sent in an email. She says, losing hope in Lululemon. What do you think? Lululemon has been on a pretty big downward slide since the start of the year. More competitors. They haven't been able to sort of entice customers. Maybe sort of the choices in their line has not sort of hit home with consumers, but they haven't had a bounce back. Some were hoping for a bounce back here. What's your forward look on Lululemon?
They spoke earlier about the retail industry. And what happened is Lululemon lost its coolness factor. And when that happens, you have a negative SSS, same-store sales growth rate. And it's very hard to come back from that. So they really need to reinvent themselves and get customers excited again about the product. So they're working hard to do that. And if they are successful, this will be a massive comeback. But it's very difficult to engineer this type of comeback and to occupy a very special place in consumers' mind when it comes to the product that you're doing, that you have. So I would be cautious on Lululemon, maybe have a third of a position, but not more than that, but very much patient to see for that turnaround. Now, if turnaround does come, you can buy with confidence. Even if it's 30, 50% higher, you can really buy it with confidence. So it's okay to miss the first comeback on the stock price, but to really de-risk your investment. That's how I would approach Lululemon.
Okay. We are going to take another quick break. Back with Andrey Omelchak in just a moment. Stay tuned. Welcome back. Let's go to an email from somebody who did not give their name. Can I please have your guest's opinion on Go Easy. There we go, from Anthony. Is it a good time to buy? And that's Go Easy from Anthony. What do you think about Go Easy?
I think Go Easy is a solid hold at these levels. They have a new CEO in place. He's doing a great job, actually. He's communicating that they want to double their loan book over the next, I believe it's 5 to 7 years. So it's a pretty good annualized growth rate for the loans. They're expanding into the auto business and other adjacencies into the secured credit and not just unsecured credit. So it's becoming a more diversified financial services company with a very high return on equity at the same time. If they can deliver on what they're communicating, the stock will do really well. Having said so, a lot of positives, near-term positives are priced in. If economy gets a bit weaker, you'll be able to buy it at a, much cheaper levels still. So I think half a position is warranted right now. I would not go full weight on Go Easy right now.
Is it easy enough for them to gain more market share moving forward?
It's easier than most people think. Because
Why is that?
The market share is still very, very small, especially on the auto side. They're really just scratching the surface. So Canadian market for them, especially non-prime lending, is quite big. So they have a small market share there. And on the prime side, they're really, really a small nascent player. So they can double the book, the loan book, I believe.
Okay, let's go to the phone lines. And Kareem is calling from Ajax, Ontario. Hi, Kareem.
Hi, good afternoon. Thank you for taking my call. I'd like to request your guest's opinion on Propel Holdings, if it is a buy, hold, or a sell at this point. Thank you so much.
Okay, thank you for the question. Propel Holdings, also in a similar vein. What do you think of Propel?
So unlike Go Easy, where I would put half a position right now, I think Propel is a very strong buy right now. They're growing at very high rates. They can continue to compound their earnings at 40% plus annualized for several years to come. It's a top management team. They have been able to develop a global business, as a matter of fact, so it's not just Canadian-centric. Most of their business comes from US. They've done a very successful acquisition in UK. They're growing very fast in UK, very profitable business there. And I think they can potentially do more accretive acquisitions as well. So it's both an organic growth rate story, and it's also an accretive M&A story on top of that. So it's, I'm very bullish on Propel because the valuation levels don't reflect the growth rate of the business. And also they're growing lending as a service part of the business where they take no credit risk. So that's very profitable, very high return on invested capital. Once again, no credit risk attached to that. And I think they can announce more partnerships in expanding their lending as a service as they have commented on the last quarterly call.
Why do you think they've been able to grow the way that they have? Is it just the management team's pursuit of that, or what has helped them?
So it's a third company that this management team is building together. So they're true entrepreneurs. They have sold to businesses in the past. It's a third business they have built together. So they're really top individuals working together, building businesses. They built everything cloud from the cloud beginning. It's AI is helping them as well. One of the gentlemen on the staff, I believe he's a at least master's or PhD graduate from MIT, focused on developing their tech stack. So they have built the business to be fully scalable from day one. And that's the reason why they're able to do it this way. So.
Okay, good to know. Let's go to an email from Patrick. He says, hello, your opinion on business and valuation for K-Bro Linen. They do, I think, hospital and hotel linens. Is that right?
That's right.
This company you like?
I think it's a solid hold. I don't think you're going to double or triple your money investing in K-Bro. But if you want something steady Eddie, somewhat exposed, of course, to the Canadian economy dynamics, but still really well managed with a high market share in Canada, I think you're going to be well suited, and you get to collect your dividend on top of that.
So if they do hotels, there would be concern about whether or not people are traveling, I guess. But if they do hospitals, then that's a pretty standard income for them.
Yes, hospital business is very steady, Eddie, exactly. So there's a portion of the business that's not volatile, and there's a portion that's cyclical and exposed to the economic activity. But overall, it's a pretty well diversified between those two segments, and you can be sure to collect your dividend.
And they're in Canada. Are they in the UK as well?
I have to double check how much presence they have in UK, but it's mostly Canadian-centric operation for sure.
Got it. Okay, let's go to another email then we have from Terry. Can I get your take on Cargojet? Is it time to buy or time to sell? We will pull up Cargojet and have a look at that. Is Cargojet tariff affected?
They are impacted by the tariffs for sure. They're impacted by how many goods are moving across Canada. As you know, there's been a big buy Canadian dynamic happening.
So that would be good for them?
That would be good for them. At the same time, if some of the volume from the US is coming less, they can also be impacted to some extent. I think it's a solid accumulate on weakness type of situation. I think it's a mission critical in Canada. Nobody's going to replicate what they have built. It's next to impossible to replicate. It costs too much money to do, and the return on capital on the new investments will not be very high. So once economy in Canada activates, Cargojet will do extremely well. In the meantime, I think you get to buy the company at a pretty attractive valuation levels.
Let me ask you, because I'm looking here at the chart over the last 5 years, and of course we see the bit of a dip at the start of this year, as we talked about, which could be part of the tariff effect. But it's been on a steady decline from 2021, sort of end of 2021, down. Any reason for that if they're getting, all the Canadian business, as you mentioned, because they're the only ones working that route?
They have had some missteps for sure over the years. I think right now they're more streamlined as an operation. They also had a contract renegotiation, I believe, with Amazon. So that's a big client of them. So, that has impacted the business. It's been hard to grow organically for them. But I believe at some point, once the pricing is normalized, you have a new floor, new level from which you can build upon. So I think we're approaching those levels.
Okay. Let's also talk about Dollarama for a moment. We had a call, but we lost the caller interested in investing in Dollarama, which is a growing company. They are opening new locations all the time. It's going sideways. Has been going sideways most of the summer here, but 40% up over the last year at $187 today. Is this a company that you like, Dollarama?
I like Dollarama, yes. I think it's a phenomenal compounder for years to come. Frankly, I've been surprised over the last 10 years that the pickup in competition in Canada hasn't really happened. But they built something unique. Their distribution systems are quite incredible. It's highly defensive as well. If you're worried about overall market pullback, you can buy Dollarama. So the trade down type of dynamic helps them quite a bit.
Are they gaining new consumers? I'm wondering how they continue to do well. They obviously offer lower price point. People are interested in that. Sometimes it's harder to get other people who've never shopped at Dollarama to come into Dollarama, but it feels like that's beginning to shift now.
Yes, they're expanding the consumers they have a touch points with as a result of customer trade down dynamics in Canada, unfortunately. But that's helping their business. They're also introducing new pricing point. You can buy furniture now in Dollarama.
You can buy furniture?
Yes, basic furniture.
Kind of what IKEA used to be.
That's right. I'm not saying Dollarama is next to IKEA.
But I remember IKEA. It was basically a couple pieces of wood put together, and that was your table, right? So right. I haven't seen the furniture yet at Dollarama, but they're moving into a market there.
Yeah, over the years, they introduced a $2 pricing point, $3, $5. Now you have a higher price points, which will be introduced. At the same time, Dollarama is expanding aggressively in Central America. So there's a huge market for them there.
Okay.
So I would not discount this management team and the ability to keep growing.
All right. We are going to leave that part of the show right here. No more phone calls or emails, but we do have top picks from Andrey when we come back. Join us tomorrow on Market Call. Gordon Reid will be on the show, President and CEO of Good Read Investment Council. He'll take your questions on U.S. equities. And if you miss Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for new picks from Andrey. We're going to start with Electrovaya on the TSX. Tell me about the company.
Electrovaya is a top battery manufacturer. They operate in Canada and they're also expanding in the United States. They're exposed to the high growth industries. Some of them are growing at 25% plus annualized. Think of robotics, warehouse automation, aerospace and defense industries, potentially even drone applications. They're about to triple their manufacturing capacity next year in New York State. As a result of that, we're going to see big expansion on top line and actually margin expansion as well. This will be very much margin accretive. They work with the top clients like Walmart, Toyota, for example. They just announced a new OEM relationship in Japan and said in a press release more are coming. So it's a booming small cap company that's going to have a very much growing top line, margin expansion, and profitability, of course.
Who would be their competitors?
The main competitors are low-quality Chinese battery manufacturers. So what's working very much in their favor right now, and that's the reason for the booming demand, they just started a second shift in their Mississauga plant because of the growing demand, because U.S. companies don't want to buy batteries from China. That's a big issue. So Buy American is working in their favor. They also have the best product in the industry, 100% success rate. The battery never went on fire, never exploded. So think of data centers, for example. You don't want to have a battery there that can potentially explode. So that's playing very much in their favor as well. So they qualify for Buy American, and they qualify also for 45X credits, which are helping the new manufacturing facilities in U.S.
All right, good to know. Let's move on to your next pick, which is TFI International on the TSX. Which is transportation and logistics, which has been pretty beaten down, as we can see from the start of the year around March. April lows crawled back a little bit up to 130.16, but down 33% over the year. Why is this making your top pick list?
TFI has a top management team. They're one of the best consolidators in the industry. And the trucking industry has been in recession for about 3 years. So I believe we're very close to the end of the trucking recession. It has been overextended. At the same time, you're buying TFI International with 10% free cash flow yield on the next 12 months basis. And under normalized trucking environment, potentially 13 to 15% free cash flow yield. So you have a company that's doing a lot of things right also. Their US LTL operations are finally turning the corner. You're seeing very positive organic improvements on US LTL. That means less missed pickups, better client experience. And if they continue on this path, which I believe they will, better pricing, which nobody's talking about yet.
Why do you feel like the trucking recession is almost over? What has led you to believe that?
Well, it's a supply-demand type of dynamics. You have to see how many trucks are being built, and you have to see how many goods are moving across North America. And typically, trucking recession lasts about 18 months to 2 years. So this has been a very much overextended trucking recession. And as a result, I think we're really close to the bottom. At the same time, TFI is buying back a lot of stock. The NCIB is very active. And the management team, I said, is top-notch. So it's a great time to accumulate.
Okay, let's get to your third pick then. Matter Corporation on the TSX. Tell me about Matter.
Yeah, Matter is an industrial solutions provider company. They're almost done for their transformation journey. As a result of that, we're going to see margin expansion coming as soon as next year.
What kind of transformation were they doing?
They divested a lot of non-core operations. Matter is a company that used to be called Shakor, so exposed a lot to the energy industry. That's no longer the case. They have some exposure to energy via their pipeline business, but at the same time, it's a diversified industrial company exposed to the high growth verticals within the industrial complex. I'm thinking of about 10% plus annualized revenue growth rate within the verticals where they're exposed. It's taken them some time to undergo the transformation, but I think they're very close to completing that journey. So we're going to see margin expansion as soon as next year. And I think we're going to see a pickup in the free cash flow conversion and profitability.
Who would be their competitors in this space?
They have a lot of different competitors in different industries, so you really have to go case by case. They do have a leading market share in the water tanks business, also used for the fuel refueling stations. Actually, that business is booming. We used to talk a lot about electric vehicles. Now, very few people discuss electric vehicles. And guess what? The gas stations business is booming, and the replacement cycle has been overextended for those for the tanks underneath the gas stations. So they have a leading market share in that, and that business is doing really well.
I just want to end talking about tech, which is where we started the conversation, because we talk about valuations and we talk about which companies are delivering where the valuations are high, but you don't have concerns about them delivering down the line. What is included in that umbrella as far as we talk about NVIDIA? Are there others you think will not have a problem delivering down the line?
I think you have to be exposed to the mission-critical industries that are here to stay, that are growing for sure. For example, I believe that cybersecurity business will boom. AI comes with a lot of benefits on the margin expansion front. At the same time, I believe the number of cybersecurity incidents is going to increase a lot. Those businesses are booming, and the clients are signing up for what they have in place. I think, taking a more broader perspective, I think simple businesses which are easy to replicate, you can ask AI to build a different technology solution. Those will be gone, and they will become commoditized. Now, if you're integrated with your clients, and it's very hard to displace you, they're going to benefit tremendously from that, because there's a margin expansion and opportunity there.
All right. Andrey, I got to leave it there. Thank you for your time, and thank you for joining us on Market Call. We'll see you again tomorrow.